Hi, good morning, everyone. It's Sean with Paycheck to Portfolio. Hope you're having a great weekend so far. Today, we're going to talk about staying fully invested in market volatility and how you don't need to fear volatility if you approach it from the right mindset and dollar cost average through that. Basically, what dollar cost averaging is it's buying at the lows, it's buying at the highs, and it's buying at the averages between those two and smoothing out that volatility over time. So we'll take a look at what volatility is, the historical context of bull versus bear markets, the functionality of put options, and then some portfolio compounding. If you're new to my channel, all of my W 2 income rolls into a brokerage account. I don't live out of a traditional checking account. I fully invest in the three buckets: long term growth stocks and ETFs, closed end funds, and high yield funds. What that gives me is equity, appreciation, and cash flow, which allows me to invest my whole paycheck on the front end instead of spending to zero and compounding everything so I can retire in, say, 5 to 10 years versus the normal 30-year compounding cycle. So, what my dividends don't cover, basically my margin covers in the form of a bridge or a float. So, right now, my dividends are between $4,500 and $5,000 a month. My living expenses are about $8,000 a month. So I intentionally run at a small deficit there so I can continue to snowball my dividends, which will essentially set me free from a 9 to 5 job. And that's the whole point of being fully invested on the front end. Before we dive right into the deep end, let's take a look at the portfolio. It's been a rough couple weeks in the market with some volatility. Obviously, folks are talking about maybe an AI bubble or AI concerns. My personal opinion, and all I can do is speak for myself and make my own thesis and apply my strategy personally. Obviously, each individual has to make up their mind on their own, but people are comparing this to the dot-com bubble back in the day. And personally, I think it's different because AI takes infrastructure. You have to have electricity, you have to have plants to house computers and different things to make AI function and work. So there's a lot more infrastructure behind that, in my opinion, which will spur the economy forward and growth forward, as opposed to just the dot-com bubble, which was the internet and different things like that back in the day, right? So looking at the portfolio, my net account value is sitting at $163,000. Again, the great thing about the paycheck to portfolio system is all of my W-2 income or earned income and all income really across the board is coming into the brokerage account. It's being fully invested into those three buckets that I articulated earlier. So even when the market's pulling back or my total unrealized gain is down, my cash is still coming in. My dividends are still dropping. It's allowing me to buy now at lower prices. When it recovers, it will bounce off of that. And you'll see that coming out of the April tariff situation that I'll touch on later. But currently, my total unrealized gain is sitting at $26,312. Again, Friday was a volatile day in the market. We opened up 1% or 2 down. So I was down, $4,000 or $5,000 at the opening. And then I got negative during the middle of the day into positive territory, and then it flattened out during the end of the market day. So ended down there, $944. And if you look at my performance, my year-to-date performance here, you can see year-to-date I'm sitting basically at 32% time-weighted return. What this does is it does not account for cash flow in and cash flow out. This is strictly the pure performance of the portfolio with growth, dividends, and expenses calculated in. You can Google that if you want more information on how E-Trade and other brokerages calculate time-weighted return. It's all open for you to look at. So the S&P 500 is at 14.5%. The NASDAQ's at 18.6%. The Dow's basically at 11%, and the Russell's at 7%. If you look at the 2-year chart, because obviously we just looked at year to date, you can see I'm sitting basically at 79%. The S&P's at 52%, the NASDAQ's at 66%, the Dow's at 37%, and the Russell's at 40%. What I was talking about earlier, and you can see it here on the chart with the tariff situation, Was there a drawdown? Yes, absolutely. But staying fully invested and managing with put options allowed me to bounce off of that really strong, just like you were jumping on a trampoline. And that's the impact of buying during those down markets, is you get those cheaper prices, obviously. And then when the market rebounds, you can explode off of that, right? So I want to jump right into looking at my historical values tab. Now, this shows cash flow in and cash flow out. So if you look back at December of 2024, my net portfolio value was basically $8,000. If you look at it today, I'm sitting basically at $163,000. So while living fully out of my brokerage with money coming in, money going out, and the growth of the portfolio, it's up $47,000 essentially. If you go to the 2-year chart, now in full transparency, I started living out of the brokerage right around this area here, but you can see that the stock market's not linear. There's going to be up months, there's going to be down months, but the overall trend is upward. And then you can see the effect of the tariff situation where I was able to bounce off of that strongly because of being fully invested and staying in the market and accumulating more shares at cheaper prices. So that's the power of the velocity of cash flow coming in and dollar cost averaging through the market. So let's jump right into volatility and break this down step by step together. A lot of detailed information here. So most people fear volatility because they think their portfolio is breaking. The truth is, volatility is normal. And if you know how to stay fully invested through it, your compounding actually gets stronger. Volatility feels like risk, but it isn't. Volatility is movement, risk is permanent loss. When the market pulls back, you only lose when you sell an unrealized loss. If you're staying invested in your dollar cost averaging through funds that you actually believe in, over time, obviously those things grow. So volatility is different than risk, and risk is different than volatility. But if you look at the actual definition, market volatility is the amount and speed at which prices move up or down over a given period. High volatility means prices are changing rapidly. Low volatility means prices are moving slowly and predictably. Volatility doesn't tell you whether the market is good or bad, it only tells you how fast prices are moving. In plain language, volatility is the pace of price movement, not the direction. So you can see there's a couple charts you can look at if you would like. Let me actually start up here because it's a little bit more simple. So the S&P 500 has basically the VIX chart, which I took a snippet of down here that you can see. The NASDAQ is more obviously tech weighted, so that's VXN that you can look at if you're interested. And the Dow Jones would be VXD. But if you go Google the VIX chart, this is what would come up. You can filter by days, months, and years. So I simply click the max option here, and you can see there were a few times throughout history where the market was very afraid and volatile. So obviously, 2008 with the housing crisis and the financial crisis was the highest peak in recent history. The COVID situation, obviously, in 2020 was the next highest peak. And believe it or not, the Liberation Day tariffs were the third highest peak in most recent history. So we just went through basically a correction back in April, the third highest volatility event in the last, 20, 25, 30 years, basically. So if you're interested in looking at volatility and you want to look at those charts to compare, you can certainly do that by looking on Google or simply researching it yourself. For historical context, I want to talk about bear markets versus bull markets because sometimes I'll get comments around, well, how will this perform in a bear market? Or are you going to get liquidated? Well, first of all, I always have put option insurance on, which we're going to talk about next and what that looks like and basically how to apply that. And I have multiple videos around put options if you want to check out my channel. One called the Market Crash Cheat Code, and the other one is how I protect my portfolio from a market crash. You can see both of those videos on my YouTube channel, and I touch on those in detail and how I apply them and my rules for put options if you want to deep dive. But basically, if you look at bear markets, let's start here. The bear market's average decline is 36%. In our history of capitalism in this country, 100% historical recovery rate. So the market will always recover. It's just a matter of time. Now, if the market doesn't recover, that's a different situation. We might be fighting for our country at that point, because we're fighting, or maybe something bad's going on at that point, right? So often recovery is faster than people expect. Very much like you saw in the tariff situation. I put a highlight on my performance tab there where the bottom was with the Liberation Day stuff, and just how quickly it bounced back from that V-shaped recovery. So on the contrast, bull markets average 4 to 5 years. It's 75% of the market years are positive. And the biggest gains usually happen right after the biggest fear or the biggest pullbacks, which you can see in my chart over here if you scroll to the right, which I showed on my 1-year tab. Again, I highlighted the bottom and the bounce back to the top. So, if you were selling around here, then you were realizing those losses. When you're fully invested and your dividends are coming in and your equity stable and your put options are kicking in, you're simply buying more when everybody else is selling off, which allows you to compound much faster, which is why you see the percentage of return there. Going to the bottom, again, bear market example, the market drops 36%. Let's say you have $100,000 invested. That would become $64,000 in that event. This feels scary, but here's what people miss. Typically, bull market recoveries, let's just say in this case, 152%, now turns 64,000 into 161,280. This means you lost temporarily, you gained more than you lost, and staying invested made you wealthier than before the drop. Now tie in all of your earned income going in there and buying more at the bottom, and you can exponentially increase that over time. So to me, the risk is being out of the market versus being in the market and hedged accordingly. So I think the data represents that, and I think it's self-explanatory. But again, if you look at the bull versus bear market historical comparison, I won't go through every line item here, but it will be here. All of these documents will be in our membership Discord where folks can look at the Excel file and read through it themselves if you're interested. And so I called out a lot of what we already talked about here. It's just more of a summary. So let's jump into put options and basically, some of the visuals that you can use to assess put options and how you can apply them to your portfolio. So what is a put option? The simple definition is a put option gives you the right, but not the obligation to sell an underlying asset at a specific price, the strike price. People use put options for 2 reasons: hedging, protection when the price falls, that's what I use these for, and speculation, to profit from a decline. I'm a long-term investor that's fully invested on the front end using traditional compounding methods, and I'm simply using put options as insurance so I can stay fully invested. I believe the power is compounding and cash flow versus speculation and day trading. That's my personal opinion. I've made a lot of money in years past day trading, and I've lost a lot of money day trading. The consistent power is compounding growth and fully your income, in my opinion. So that's the way I handle it. I treat it as number 1 on this list, but some people do speculate. There's concepts called the options Greeks that are very intricate. So again, we have training resources on our membership Discord that will walk you through teachings and some threads that we've talked about. But basically the delta is the sensitivity to price changes. So, a negative for puts or a negative 0.4 delta means that put gains 40 cents for every $1 drop in the underlying. So delta is the sensitivity to the price change itself. Theta is time decay. It's always negative for long puts. The options lose value each day as expiration approaches. Vega is the sensitivity to volatility. We talked about the VIX chart and the fear in the market. So positive, a put becomes more valuable when implied volatility goes up because everybody's nervous and everybody's scared. So the supply and demand of that volatility spikes the options contract. So there's confusion sometimes around options that you need it to hit your strike price before it becomes valuable. That's not true. if you look at the snippet I took over here, and I'll show you this, this is from Thinkorswim, which is a Schwab product. As everybody knows, I have a brokerage out of E-Trade, but of course I've used Thinkorswim before, and I still will use it for visuals because I like the visual appeal of it. But you can see this little line right here, and I'll show this to you on their website, shows you the movement of the options contract before it ever hits the strike price because of the options Greeks and what's happening there. So if you look at gamma, it's the change in delta. So it's positive. It shows you how quickly delta increases as the underlying moves. So as the asset moves, then that delta obviously adjusts and reacts to it. But right now over here on the right, just looking at this, I added this text box over here just so you could see it. Basically, one of my put options right now is QQQ. The date is December 12th of this year. I picked a 550 strike price, or a 550 put. I paid $311 for this, so it's 3.11 times 100 because one put options contract equals the equivalent of 100 shares of the underlying. So you take 3.11 times 100, you get $311 is what the cost was. And a 10% drop here would mean that QQQ would hit 550 essentially. If you were to come over here, that would equal a gain of $1,600 in that case. With a 20% drop, QQQ would drop down to 489, and the equivalent price would move to $4,000 plus. It would actually be more than that, but the price actually stops here on the visual. So it would be well over $4,000 with a 20% drop. So as you own these put options, they provide that downward hedge for you so you can stay fully invested. Looking at E-Trade, if you wanted to go buy a put option, basically you'd go trading options. You would click QQQ here. Now the market's closed. You would click put options down here. You would pick put, buy to open. You would go December 12th or 30 days out. And I go 10 to 20% out of the money for my normal standard put option. So you saw that, let's just say 550, or 545 we can pick. Now, again, the market's closed. You can see right now it's between basically $250 right in that window right there. If you enter a 2.5 as your limit order, I always use limit orders on these contracts so I can get the best possible price. Then you would basically preview that trade and execute that trade, and that would provide your insurance. Looking at it on Thinkorswim, if you want something visual, you can open a paper money account here. They have a little bit better visual tools, in my opinion. If you're wanting to learn and you're wanting to play around with options, simply open up a paper trading account called Paper Money, and you can see I entered the same put option here that I'm showing. December 12th, 550 put, one contract, buy. And you can see when you click on this at the top left of the screen, you're going to see that number move. So you can see if the price dropped, how that movement is happening on the current day, and then the P&L on the expiration date. But obviously, the further the market pulled back, or QQQ, the more valuable these contracts move. Now, the neat thing is you can see time decay in action here. If you click on this button, you'll see how that blue bar slowly comes down because of time decay, and how your put option becomes less and less valuable over time because the Greeks are moving against you at that point. So I roll my contracts about 5 to 7 to 10 days, right around there. So I have it always 30 days out. And so I get asked questions, well, how do you roll your options, or how do you manage your options? So let's go back to my portfolio here. If I can get on the right button, let's go portfolios. If you roll down to some of my put options here, all you would have to do is hit roll right here. So trade and roll. All rolling does is it makes it convenient for you, and it sells the current option, and then you would simply go out another 30 days, let's say January 16th. So it would close one and reopen the other. That's all rolling is, and that's how simple it is to do on E-Trade. So I wanted to show you the visual of what this looks like and how quickly put options can move for you and hedge your portfolio so you can see it from a visual perspective. If you look at portfolio compounding, again, I want to talk about staying fully invested in the market. And I'm going to move some of this over so you can see it. But if you look at a 5-year comparison versus a 10-year comparison on compounding, I took a 15% metric. If you look at my actual portfolio, I'm sitting, again, let's go back to complete view here. Let's go to my portfolio and we'll look at the performance again, just so transparently you can see it. So if you look at my 2-year performance, again, getting close to 80% here, my 1-year performance at 32.6, basically 32.7%. If you look at that, you can see I'm far and away above this 15% value. But just for conservative conversation, let's talk through what this would look like for you. So if you're staying fully invested at 2,000, 5,000, and 10,000 at a 15% value, you can see what you would contribute in 5 years that you would have otherwise spent to zero. 120,000, 300,000, 600,000. The 15% value of that would be 202,000, 505,000, basically a little over 1 million. So your growth at 15% would be 82,000, 205,000, and 410,000. Obviously, I'm getting closer to 30% returns, but you can see the power of what you're contributing fully on the front end instead of the leftovers with a conservative growth value could easily get you to $1 million over 5 years at $10,000 and over $500,000 at 5 years there. The 10-year curve is obviously much more pronounced because there's more compounding going on there. So at the end of 10 years, you're looking at $618,000 with a $2,000 monthly investment, $1.5 million with a $5,000 a month monthly investment, and over $3 million with a $10,000 month monthly investment. You can see the power is contributing your full W-2 amount that you would have otherwise spent to zero. And then you get the compounding layer on top of that. And then you get the actual growth of what that would do for you. At the top right, this is my gross portfolio value shown in Snowball Analytics if you want to see a visual for yourself on your own portfolio. But you can see December 2024, my gross portfolio was sitting a little over $160,000. But because I'm fully invested, every month you can see my gross portfolio value is constantly gaining speed, even with the market tariff situation I want to call out. And now I'm sitting over basically $300,000. If we look at my balances, again, just for the sake of transparency, if we look at my balance here, I'm at $330,000 currently, just so you can see that, okay? So that's the velocity of money, and I actually took a snippet of it here and showed you. And you can see even right now with the market pullbacks, my equity is sitting at 50.46%. So even with the market pullback, because my money is coming in, I'm still buying, I'm getting dividends, my equity is stable regardless of what the market conditions are doing. And that's the key to compounding. Looking at a few questions, I wanted to talk about a few of these. So Brad asks all about put options. One of my biggest fears about this strategy is what it does in a flat market. So, or slightly down market is what he's asking about. And my response was the system thrives on staying fully invested, just like I showed, because money's constantly coming in. You're dollar cost averaging all the way through that. So you're continuously buying shares. And over time, the compounding obviously outperforms the sideways to down market, as I showed in some of the data already presented. So because it rains says is the option strategy for me, how big should the portfolio be when I start doing this, deciding when to buy with market volatility, when to add weekly puts. I will do that in very volatile markets. And normally, when they're very volatile and the market's very scary, just because you can see it in the pre-market, you can feel it, you kind of sense it when the VIX spikes. But basically, I always have put option insurance on because I'm fully living out of the brokerage account. If you're fully living out of your brokerage, always have put options on. I carry at least, on average, 2 QQQ and 2 SPY puts always, and it allowed me to stay fully invested. Now, If it were me, when I hit $20,000 or greater, and or when I'm living out of the brokerage, I would start to add those put options on. And then if things get really scary for you, you can add a couple weekly put options on. Now, just keep in mind, I don't expect these to win. I expect it to hedge my portfolio. So I look at like homeowners insurance, not a trade to win. David asked, my account is small and heavy and high yield and it's hurting. I don't know how to use puts or calls. And hopefully me walking through this with you transparently on YouTube helps. If you need more catered service, please see our membership Discord or reach out to me directly. I'm happy to help. But what I would say is please focus on building out growth and closed end buckets. Diversification is the key. Two of the biggest mistakes I see in investing is a constantly changing strategy because people are emotional and they don't know how to handle things and they're constantly changing. And then obviously it breaks, right? The second mistake I see is people chasing the highest yield because it's quick money. Um, my approach is balanced from a business perspective. Again, I want equity, growth, and cash flow. So all of those things are working together, which allow me to stay fully invested, which is the true power of the paycheck to portfolio system working in harmony together. So just diversification is key, is the encouragement I would give you, and to stay the course there. So um, an- uh, uh, Kurt's vid said, please explain not just how to place a put option order, but how to actively manage. And again, I touched on that with rolling 5 to 7 to 10 days ahead of time. If my puts are up in value, again, I'm on average carrying 2 QQQ, 2 SPY. If my puts are up over 100% gain, I might close one QQQ and one SPY and let the other one QQQ and SPY run as compounding insurance just in case a correction or a crash comes. But I'm always adding that insurance back on. So again, I'm not looking to make money off of these necessarily. I'm looking at them to pad my equity. So I hope that helps. Looking at the resources, I have a starter kit that's free. You can book a one-on-one strategy call with me. You can join our private membership in Discord where we're having a lot of conversation and tools, and all of my documents will be on there. And then I have a white glove coaching and setup if you want me to walk you step by step through my system and how I approach it. That's all available to you. I hope that this has been helpful. I hope that we can all keep a level head and stay invested in this market and protect ourselves like business owners. Please don't be overly emotional with this. Be wise and stay the course. Please like and subscribe, and we'll talk to everybody soon. Hope you have a great rest of your weekend. Bye.